Hello everyone, my name is Harinder Singh Sandhu and the name of the channel is Financial Punjabi. In today's video we are going to talk about real estate, numbers and the timing. I wish I could have purchased more houses if I could have purchased more houses about 10 years ago, and the numbers would have made real sense by that time. But it's all about timing and numbers, when you purchase it and what you pay for it. So when you go to a lender or a bank, there are different criterias which the lender is going to look into, and there are different terms into that. Let's start about GDS, your gross debt service ratio. So currently it is 39% for a Canadian to get approved by the bank. It should be below 39%. And what is GDS, gross debt service ratio? It's principal plus interest for your mortgage portion, and your property taxes, which is per month, calculated per month, plus your heating cost, because you can't live without heat in Canada, especially in the winters, and half of condo fee. And when you divide it by income, it becomes your GDS. So it should be smaller than 39% to get approved by a lender. So GDS takes into consideration all the expenses, almost all of the main expenses which you will be going to pay for the house. And there's another term which is considered by the bank or look into by the bank, is your total debt service ratio. It contains all the portions of GDS. That's your principal, interest, your heating cost per month, plus your property taxes calculated per month, and condo fee, half of condo fee. That's still your GDS portion of your expenses. But TDS takes into consideration all the expenses like your monthly car payments, any credit card payments which are going out monthly, and any of your student loans. When you divide these all expenses by income, that becomes your total debt service ratio. So GDS are the expenses related mainly to your home, and TDS are all the expenses which you have to pay in monthly payments. And there could be more expenses that should be added here, but before you go to bank or for a loan, or you are already talking with a mortgage specialist from a bank, they will look into all of these factors. Currently, the maximum TDS allowed by banks is 44%. So the maximum TDS should be less than or equal to 44% to qualify for the good bank or a lender A. Now let's discuss another term, that's loan to value ratio, LTV. That's loan advanced for a mortgage divided by market value of the home. Let's say someone is trying to buy a home, and the cost of the home is 1 million, and he's putting down 20%. So loan advanced is 800K, and the market value of the home is 1 million. So it becomes 80% loan to value ratio. So let's talk about what should a buyer be aware of, like before buying a home, what are the calculations or the numbers that make sense. Let's go to a website, that's my website, soldwithsandhu.com. We will go through some calculators to know what should be the purchase, what should be the mortgage amount, the monthly mortgage amount, principal plus interest, and the down payment that is required to purchase a specific house. So let's so the CMHC so there are four calculators here. The CMHC calculator, it will give you the CMHC mortgage insurance fee or the Genworth fee that is applicable when you are putting down less than 20%. At 20%, the mortgage insurance fee becomes zero. Then the mortgage calculator, we will go into detail in a while. And then comes the land transfer tax calculator. So Toronto has two taxes, the provincial land transfer tax and the municipal land transfer tax, and the first time home buyer also gets a rebate. And then comes the affordability calculator, like what is the annual income for the main applicant, the co-applicant or the spouse, and then the what are the credit card payments, car payments, and calculating the property tax, adding the property tax, condo fee, heating cost, and how much I can afford monthly as compared to my monthly income. So my website has different links, like the community links or the latest updates or the testimonials by the clients, and then my real estate blogs, which you can read here. And if you are a buyer, you can go through these buyer tips, rental tips, find your dream home, and then comes the seller, the steps or the neighborhood watch or free home evaluation that I can do for your home. And then comes the listings. You can search for properties based on address or MLS. And let's go to calculators. So the mortgage calculator, let's say the purchase price is 800K. Someone wants to purchase a home for $800,000. For the first 500K, you can put down 5%, and for the 300K, you have to put down 10%, and that becomes approximately 6.88% for 800K home. That's 55,000. And then come for when you're putting down less than 20%, you can see here you have to pay down a mortgage insurance fee. When you are increasing your down payment, the mortgage insurance fee is going from 29,000 to 22,000 to 19,000 for 15%, and becomes zero when you're putting down 20%. For 800K home, the 20% down payment will be 160K, 120K when it's 15%, and for 10% it's going to be 80,000. And then you can see the total mortgage required. This mortgage insurance fee will be added to your total mortgage. So you will be paying an interest because it's added to your mortgage. You're paying interest on the mortgage insurance. And then comes the amortization period. For 20% down, you can go up to 30 years to pay down the original borrowed money, that's 640K. And for less than 20%, you cannot go more than 25 years. Then comes the lender's rate. We can select between different rates, those are available. Let's go with 3.64%. And you can see here the mortgage payments for 25-year mortgage with about 6.88% down. The mortgage payment is approximately 4,000. For 20% down on a 800K home, because there's no mortgage insurance fee by CMHC, the 5-year fixed rate 3.64%, you're getting around 3,000 monthly mortgage. That becomes your principal and interest. And that's not the only expense. There becomes a property tax and other expenses too, which we will go in detail. And then comes the land transfer tax. You have to pay the land transfer tax out of your pocket at the closing. As I told you before, the Toronto has provincial land transfer tax, the Ontario land transfer tax, and the municipal land transfer tax. And if you're a first-time home buyer, you can get up to $8,475 rebate. And if we select Brampton with the rebate is $4,000. There's no municipal tax in Brampton. And then let's go with Windsor. Ontario, Windsor, and again the provincial land transfer tax remains same, and there's a rebate. Then becomes the closing cost, the cash required. There could be a condominium where you have extra expenses, let's see what they added. It's the estoppel certificate or the status certificate, but normally the seller pays for it. And so when we select house here, the type of home, and 20% down, the down payment 160K, the PST personalized sales tax becomes 0. Let's select 15%, and here comes around $1,500. This personalized sales tax you have to pay from your pocket on the closing day, because it's a tax on the mortgage insurance. For 15% it was 19,000, and this 1,500 is added on top of that, but this tax you have to pay from your pocket. And then comes the land transfer tax, which we just calculated here, which was around $8,475. And then comes a lawyer fee, which could vary from 1,000 to 1,500 depending upon the asking price and the lawyer. And then comes the title insurance fee. It could be 700 or 800 depending again on the purchase price, and that becomes your total cash required. So you can see that for 10% you have to put down 92,000, and for 20% you have to put down 170,000. And does it make sense to put down 20% or 10%, which you can qualify for either, when the gap or the total deposit you have is very short by few hundred or few $1,000s of 20%? Save it and then make the 20% down. But if the difference is too much, you don't have much money in your pocket, I will suggest still go for the house if you can, and you can afford the monthly payment, so that you're building some equity instead of paying down the rent. It's always better to own than to rent, because you are building up equity. And this mortgage insurance, it will pay off, like you will see when the prices are getting higher after 4 or 5 years. I'm not saying they will always get higher, but when they get higher and after 4 or 5 years, you will not regret paying down this mortgage insurance fee. I have also paid down this mortgage insurance fee on my very first home, and I do not regret that. And then becomes the total cash required. For 20% down payment is around 170K. There could be home inspection fee. It could also vary from 300 to 500, or it could go 800 or maybe only 200 depending on the size of the home and what you want your home inspector to do on your home. What are the things he should be like you ask him to perform on your would-be home. And then comes the appraisal fee. It could be for the rental properties or the investment properties, or the bank or the lender could ask for it. And then comes the monthly expenses. These are very important. You should have a budget that $2,900 is going towards your interest and principal. Then comes the property tax around $600, which is very high because it's being calculated based on this asking price. But normally it depends on the MPAC value of the assessment value by the municipality, which is always almost less than your market value. And then comes the monthly debt payment. If you have any kind of car or credit card payments, you can add here. And then comes the utility payments like your gas, hydro, your water bill. And in bill we get the water bill every 3 months. You can add, and you can divide it by 3 and add it here. You just need an approximate if you do not own a home now. And then comes the property insurance, which could be around 50 or 60 bucks for each month. Then comes your phone bill, your cable, and your internet bill. And here comes your total around 4,000. And this property tax is still higher. You can like um, check with your real estate agent what was the property tax for the resale home a year before, or if it's available for the same year, like depending on the MPAC assessment.